All right, welcome back, Thai audiences from around the world. Really excited to have you guys back on as we go into the last and final segment of our 4-hour block that we've had. So far we've touched on startups, we've touched on scale, we've touched on funding, and really being able to tap into not only the stage of business, but also the ecosystem here in Atlanta. So finally, as all, great entrepreneur journeys go, you want to know about the exit. You want to know about the lessons learned. You want to know about the tactics, the inspiration, and then how to really be equipped with the resources and the intelligence to really do it for your own company. So I have the pleasure of introducing the moderator, who is Tom Singh, good friend and Senior VP and Resident Director at Merrill Lynch. Tom's is, he works with many entrepreneurs on a daily basis. And what he is able to do is be able to touch on success in terms of maximizing what life looks like after the exit in terms of income, how to take care of your family, how to take care of employees, and really maximizing on the value of their business. One of the things that Tom touches on is business owners thinking about all aspects of the exit planning and really putting together a resource package that makes sense and for legacy wealth to occur. So Tom, thank you so much for moderating this panel and also being a sponsor here at Thai Atlanta. And over to you to go ahead and kick this off and introduce our two speakers.
Great, thank you. Really excited to be here and be part of Thai Global and also represent the local chapter here in Atlanta, Georgia. So really excited to be a part of it and to see all of you as well. So I am joined today for our fireside chat with two really wonderful entrepreneurs. You got Andy Monin and Ashish Mistry, both with multiple exits, really pillars inside of the tech community here in Atlanta. So I'm going to turn it over to Andy to tell a little bit about yourself, your background, and then we'll turn it up to Ashish and go into his background as well. So Andy, tell us a little bit about yourself, how you got here, and just your whole story about yourself.
Sure. So my name's Andy Monin, and I'm on my third startup. I've been in the technology software space here in Atlanta for about 20 years. Started first company with a partner of mine that I was in sales and marketing for cable and wireless. Prior to that, I was with MCI, so telecommunications, and my next door neighbor, Bird Blitch, and I started a company called BroadSource. We audited phone bills. We went through startup all the way through 9/11 .bomb, and I exited that company in 2014. Started another company called VendorMate in 2005, and that company is designed to help hospitals and healthcare organizations with vendor credentialing and compliance. We found an opportunity to help hospitals better understand who they did business. So it was a software platform. We ran that for 10 years, sold that in 2014. And now I'm working on a product called Cyrano Systems, and it is a video platform that helps hospital leaders and healthcare organizations become video first communicators. So everything from hardware, software, and services to help make their videos look great. So it's everything from backdrops like this that can turn any room into a recording studio to software to help with storage and distribution, and then also have professional services and customer success to help turn great looking video into actionable, engaging content.
Fantastic, Andy. So I'm going to come back to you to find out how you went from phone bills to hospitals to video. That's going to be an interesting part of the story here. So let's transition over to Ashish. It's a fun fact. Ashish and I knew each other growing up, went to high school together, re-engaged here in Atlanta. So Ashish, you've taken a different journey through your multiple ventures here. So tell us a little bit about your background and how you got here in the first place.
Yeah. So after I got up from Tom tackling me playing football in his front yard, I made my way to Atlanta, attended Emory, and basically been in the entrepreneurial early stage ecosystem since. My first company that we started was in the managed services space, and that's about the first time I met Andy and Bird. We had a company called Vertex Networks that we launched, which was one of the first managed services companies out there doing remote network desktop fixing and monitoring. That business was acquired by a company called Leapfrog Services in 2001, and then I went on to join one of my investors, Jay Chaudhry, who was a Thai member as well, who subsequently started Zscaler at a company called Air Defense. I was one of the first 5 employees there, and was there for the first 6 years of that company through its exit to Motorola in 2008. In '08, sort of switched gears a little bit and started to do some angel investing once Air Defense was acquired, and then team up with my now business partner on the two ventures that we have, which is one is VLH Venture Partners. So it's a really a family office investment firm where we are doing early stage tech and tech enabled businesses, typically in cybersecurity, SaaS software, and e-commerce. And then I was fortunate to be able to start a company called Control Freak, which is a little bit of a side it's a side project, but we make performance gaming gear. So just like Under Armour does for traditional athletes, we've taken the esports athlete and put them front and center, creating products that improve and enhance the gaming experience. So I typically have a prop here for to show what it is, but we make everything from performance thumbsticks and grips to cables and lighting, all those things that really improve and enhance your gameplay experience, which a lot more of us are doing these days. So glad to be here. Thanks.
That's fantastic. So the money I make goes to Ashish to buy his gear, it looks like now. So I appreciate that, Ashish. So let's dive right into it here. Let's talk about your first exit for both of you, right? Probably very different from your subsequent exits. Talk to me and tell the audience here about why you decided to exit your first time. So we'll start back with you, Andy. Tell us a little bit about that situation.
Well, mine was pretty basic. So we had Bert and I had the idea of building this is back in the .com days when you could build a PowerPoint presentation and go talk to a bunch of angel investors and raise $3 million, pretty easily. And we started on that path and raised about $500,000. And this was February of 2000, and then March hit, and it was kind of a devastating event that you couldn't raise, next dollar. So we had to adjust our plan and came up with a new model. And we were either going to give the money back or we were going to go and change the business model. We did that and we ran hard, and we got to September 11th and hit us again. So we had to readjust and change our model yet again. And this was 2003. We were not really taking a salary. We're growing the business. We had customers, and when we started BroadSource, I was married but didn't have any kids. And in 2003, we had our second kid, and so had gone 3 years of just, basically poured everything into the business. And my wife was, she was a successful salesperson at Quest Communications, and so she was my sugar mama. She was pouring everything that we had back into the business, and it just got to the point where enough was enough, and we needed to find some liquidity event. And so a local entrepreneur here in Atlanta had always said he was interested in our business, but did not want to invest, but would buy one of the two of us out. So I put my hand up and said, I'll take the exit. And so I did that and worked with the management team for a year. But that was one of those modest exits that got to see it from start to finish, but it was not the kind of exit that you go, kick your feet up on a beach and finish. It was enough to kind of repay for what we put into the business and a little bit more, but that was that exit.
Sure. No, that's great. How about yourself, Ashish? I know you had sold, I guess, to Leapfrog, right, back in the day.
Yeah. And so again, probably not too dissimilar than Andy's first exit. We were, an exit doesn't mean you necessarily made a bunch of money. Sometimes it means you just got out. These businesses are easier to get into than get out of. And so to the extent you can get out of it, you're lucky. And when we were in a business with Vertex Leapfrog, that we were managing, a company's entire IT network. So if we went away, we were about to do some bad stuff to people that we actually cared about inadvertently. And so we were able to really merge the business with them. And they were really able to take over operations and fund the business, because it was 2001, right around 9/11, that we were basically out trying to raise money for our second round. And we'd done a great job in building a business with recurring revenue. So it was sort of SaaS before SaaS, but unfortunately the market conditions really determined whether or not a company is able to raise money in that type of environment. And we were 22, 23 years old. And so, knowing as much as we did, the smartest thing that we did do was lean on people that gave us good advice to park the business with someone that could help shepherd it along and take care of the customers that we'd spent a lot of time building relationships with.
Sure. And so I'm going to ask both of you the same question again. So you both have an exit, right? It's maybe not the big bang that maybe you started out to do, but why did you go back and do it again? Right? Because in my mind, right, you might do an exit in that situation and walk away, say, you know what, I'm going to get a corporate job. So walk me through that process and maybe the time frame until you went into your next venture.
Yeah, I basically took a step back and for a year in 2004, helped the new management team come in and get accustomed to the business. And so I took a job with the new and I learned a lot about myself and learned a lot about, the things that frustrated me as, someone who's running the business and asking employees to do things for you. And, I went into that role saying, I'm going to be the best employee I can possibly be to make sure that the questions and challenges that I have with managing people, I wanted to be the best employee ever. So got into that and just, the ideas, right? The ideas are always running through the head of, all kinds of concepts and ideas. And you just kind of take it from idea concept to go talking to folks. And what we learned at BroadSource was the fact that we do our job and drop contracts and invoices on the customer's desk and say, you've got 450 phone providers, Home Depot. And they would look at us like we were crazy. I'm like, no, you've got that many vendors. And the idea was, well, if they don't know how many telephone providers they have, how many other vendors do they not know about? So I just picked up the phone and called old customers and asked them about what don't you know about your vendors? And that was kind of what kind of jumped into and eventually became VendorMate. But it was just this nagging idea of why is it done this way? Or why isn't it done that way? And so that's just kind of my nature and got to chase those other ones out.
So it wasn't about chasing the dollar on that, right? It was trying to solve a problem. Would that be accurate?
Yeah. Well, what I learned is, chasing the dollar to do this is probably not the best. A job would have netted me more money possibly than, what I'd done, as an exit.
Sure. Ashish, same question to you, man.
Yeah. So I was generally unemployable, right? And so I think as most entrepreneurs are, we'd sort of faked it till we made it in that first one. But then, what was compelling was that while we had learned a bunch, we hadn't really seen everything. And so working actually with Jay was my next venture. So, Jay, who was one of my investors, basically said, hey, listen, while you didn't make a bunch of money, you may have learned some stuff. Why don't you come sit down next to me in this next one at Air Defense, and I'll show you how it's done. And so that was, for me, it was boot camp. And so I was trained, really sort of, in a lot of ways by someone who's been extremely successful and has had multiple, he's touched a lot of things and done extremely well. But he knows how to do it. And so if you can go apprentice with somebody that has a track record of success, it's a great way to learn and shortcut your learnings, because you're sitting front and center in places where you typically wouldn't get to if you're in a traditional job, as Andy would put it. So
yeah. And Ashish, just to tag on to that, talk a little bit about your background with Ty, right? Because you're a great story of coming up in the system. So talk about your background and meeting Jay as well.
Yeah. So, I mean, I was 21 when I showed up at a Thai meeting, was front and center, showed up because I had an idea to do this managed services thing, but I couldn't tell you a router from a switch. So showing up at a technology event was my way of sort of showing up to figure out who I could end up teaming with. So I show up to a Thai event, I meet the guys that had started the chapter, Raj Palamaswamy and Harish Mamtani. And before I knew it, I was on the other side of the table, checking people in at the next event and becoming good friends with them. Ultimately, building the business plan and thinking through the business in its entirety. And eventually, Raj, who was my first investor, wrote me a check for $250,000 to start the business. And he, along with Jay and a handful of others, were instrumental in just pulling me up and saying, hey, you can do this, and giving me guidance along the way. And it's a great success story for Ty, and for me personally, as a result of the relationships and really the ultimate skill sets and partnerships that we ended up landing from there.
Gotcha. Perfect. And then back to you, Andy.
One other point, Tom, it just occurred to me, and the broader Thai network as it relates to the audience here, it's impressive because one of the CTO for Computer Associates was actually one of the speakers at the event that we went to. 6 months in, when we needed to get a license from CA for a piece of software that must have cost, $1 million to $1 million at that point in time, he was gracious enough to say, hey, why don't you use it until you generate revenue? And so those relationships, that stuff doesn't happen just when you walk in off the street, but it's power of the network that really kind of that drives this. So.
No, that's a great point, Ashish, and you're exactly right about the organization. So, getting back to you, Andy, let's talk a little bit about VendorMate now, right? So you're on your second venture. What was the differences, the contrast from your first venture, right, in the phone bill business? Was it more sophisticated now that you've learned a little bit? And then let's tie in the exit piece as well. Did you have the exit in mind on the front end when you went into it, or was that any part of the process?
I think the biggest lesson was, when seeing a process go from start to finish, the exit, and then having the ability to look back, you learn a lot about what to and what not to do. And a lot of it has to do, how do you make sure that as you're building the business, that all the while you are making sure that you're positioning it for an exit at some point, not with that in mind necessarily, but just making sure, like our 16th employee was our CFO, right? And so making sure that we had, really, really strong governance in our planning and our financials, and we ran our board meetings, in a way that was, much more sophisticated than, we had at BroadSource earlier on. So, having that start and that exit, and then being able to look back and say, okay, this is how a company, we had no business starting a company in 2000. We were young and aggressive and ambitious, but we didn't have the experience. And that, that 4 years at BroadSource gave me the experience of seeing a start to a finish. And it helped really kind of allow us to see what we needed from a talent standpoint, from a resource standpoint, what it would need to look like for a private equity or strategic to come in and acquire the business. So we didn't have an exit in mind, but we definitely knew that we had to build the company in a way that when the time came, we were ready. We were diligence ready and ready to go.
So you did work with the end in mind in a sense, right? Sort of building it backwards. Would that be accurate?
Just making sure that, because of experience, making sure that you're not running around looking for contracts that are shoved in a desk drawer, to make sure that you've got, your financials you have audited financials, and just the things that need to happen, in order for someone to take you seriously and make that exit process go more smoothly.
Sure. And so I'll throw this question out to both of you as well. So now you get together, you say to yourself, all right, I'm ready for an exit. What were the steps that you took at that point that you felt were important? So I'll go to Ashish and come back to you, Andy.
Yeah. So from an exit standpoint, I think when, if I was to sort of put myself in an exit scenario, first thing I'd be thinking about is the market ready for us, right? And so, is the market on an upswing? Is it on a downswing? That'll ultimately impact your business or your business outcome. I think the other component is that can you get a hold of a good advisor? And what I mean by that is that no matter actually this is a guidance that Andy gave me, which no matter how great a banker you have involved in your business, you're still going to be selling your company. They'll facilitate the process, and they'll do all they'll calendar everything for you, but ultimately you're the pitch person. You're the person on the front lines that's doing a lot of the heavy lifting for getting a party interested or multiple parties interested. But having people that have relationships that can pick up the phone that are going to call is critical to I think ensuring a good process and really an optimized outcome for your shareholders and yourself. And so the advisors are really important to that process. And I think, like Andy had mentioned too, it's, just being tight, right? So you as an acquiring company are potentially inheriting a lot of risk from buying a company or an asset. And in this instance, you just want to make sure that you've done all the right things in many places as you can. So having audited financials. So, Control Freak's a privately owned company. There's 2 shareholders in the company, and we do an audit every year for the last 5 years, and we have no reason to spend $25,000 or whatever is what we spend. But We've got no reason to do it outside of giving ourselves the peace of mind. But ultimately, someday somebody's going to knock on the door. And when you can hand over 5 years of audited financials, then they're like, wow, you spent money in the right places. One, it shows that you're a sophisticated operator. Two, it shows that you treat your business seriously. And then three, it makes the process go a lot smoother. It's a choppy process to in any situation, but the more wrinkles you can iron out on the front end because of your ability to operate in a sophisticated manner, just ensues that you'll have a better outcome for all parties.
Yeah. Anything on your end? So you decide you want to sell. First steps, and it's interesting to hear you both, or you mentioned advisors, right? So a lot of times, so I'm in the middle of doing 3 exits, right, advising on 3 of them right now, and the folks want to use their attorney they've worked with for 15 years, right? That's just sort of their corporate attorney to do the deal. Do you feel like you can go that route? Do you feel like you need to bring in some outside folks that specifically work on M&A? I'll ask you that. Or does it matter?
So, our experience and our journey to an exit was, we started the business in 2005, and we had a great group of our early leaders of the business, and ran hard and had we caught a flyer. We really, by 2009, had built this amazing engine that had reoccurring revenue. We were probably in 900 hospitals across the United States using our product, and highly profitable. And, at that time, I had the company was probably broken down to a third of the company was owned by investors, a third I owned, and a third was owned by the employees and leadership and the team. And so everybody worked really hard. We built this asset that had a lot of value, but we were stewards of this entity. This is not my baby. I got 4 children at home. This is, I am a fiduciary and I'm a steward, and it's important to make sure that you maximize the value. And so we felt as a board and a management team that this was an opportunity for us to do that. So liquidity was a big option. We felt like the runway for us in hospitals, we were already in about 1,000, and there's only 5,000 hospitals in the United States. So you want to sell a business, at least what we wanted to, as you had that 25% annual growth, but was showing some highly profitable business. So the opportunistic the timing was just perfect, and felt like we needed to go hire a banker. And the board of directors that we had, some guys helped us lead into a process to evaluate. So we went outside, right? We had some counsel locally, but ended up partnering with William Blair and hired them as our banker. And we had a failed process and ended up doing a recap and allowed a lot of the early guys that got involved and took a risk to take some liquidity. And then we ventured on. We continued on for another 4 years with the private equity group.
Sure. And some people may not know what a recap is. Can you talk a little bit about that, how it works?
Yeah. So the idea was, when we hired the banker, was to sell 100% of the business. And we had a $100 million number in our minds. And that was what we all thought the business would be worth. And as we were going through it, we got close with one private equity group. We sent it out to strategics and to companies and to financial sponsors. And we ended up choosing one of the private equity groups, and they retraded us literally about 2 weeks before it's supposed to close. And so we've had a big decision. We went back to the board. We're like, okay, I'm talking retrade us down by like 35%. Tried to just retrade us late. Thought that there was some fatigue on the employees and the leadership team, and thought we wanted out of this thing. And so we told them, thank you, no thank you. We'll just figure it out on our own. And so we went maybe another year and a half with a couple other dance parties, and we ended up not choosing them as well, but got a call from a friend of mine that was running a private equity group. And so a recap is basically allowing, for our case, it was selling a majority stake, not 100%. We sold about 51, 52% of the business to a new private equity group that would allow the early investors and some of the early employees and management team to get some liquidity. Those that wanted to roll over and continue with the business were allowed to do it. but it allowed some of the folks to go on and start their own businesses and, take some time off or do what they wanted to do. But the recap is basically allowing us to take the business and get a majority shareholder in the business that's going to run it. They ran it from a board perspective, not day to day. The management team still stayed in place.
That's great, because I think a lot of people don't realize that's an option out there when I'm talking to folks. So,
yeah.
Ashish, did you have any experience dealing with private equity firms? Because I know there's a lot of horror stories out there. You just heard one, from Andy, for sure. What type of buyer, were you attracted to and work with?
Yeah, so we've my experience with private equity firms has been really through a lot of the portfolio companies that we've invested in through BLH. We've had some good ones and we've had some not so good ones. And again, I think PE gets a bad rap because there's certain actors that act in a not so great way, and things like retrades and just being really just being known to sort of slash and burn and optimize for cash. And there's a lot of things, but I mean, there's companies like CallRail, for instance, in which we've had PE group as an investor, and we're not close to the business day to day, but they've done a great job in managing that business, and they were extremely thoughtful. And the founders of that business have nothing but positive things to say about the guys at SageView, and again, they've been great partners for that company, and there's a lot like them. The PE guys are smart, man. If you look at the masters of the universe, most of those guys are in that seat right now, and there's a reason for it. And they know how to attract capital, they know how to deploy capital, they know how to move the shells around. And so, as the entrepreneur, if you're lucky, you can get caught in. You don't get caught in the middle. You can hopefully get an exit and you can roll with them. And so so I guess they come in all shapes and sizes and flavors. You just hope you looking at reputation is important.
And I'll say, VendorMate is a PE success story for us, because we did their recap in 2010 and we ran it up over 4 years to a $220 million exit with them as a partner. So, I have a lot of good things to say about Primus Capital and the partner we ended up, doing business with. So, yeah.
Yeah, that's great. That's great. What about the due diligence process, right? How in depth was it? The data room, again, hear horror stories about it. Is there anything that you would any advice you would give people that are watching right now, if they're thinking about it or ever having to go through the process with that?
Yeah, be organized. Get a CFO or a COO that will do all that work for you, because I think if I was to start a company tomorrow, again, if you really, we wouldn't necessarily start with the exit in mind, but I think you organize your operations with an exit in mind, just because just like you would anything else, right? You're doing any other job. Being organized is a key component of your ability to execute. And it also just shows how your level of sophistication around the people that you bring into the business and how organized they are, your hiring process. So all those things are just a function of how you as the leader and your team are operating. And so whether it's, hey, we've got all our NDAs in a folder that every one of them signs, and it's docu-signed and it's by date. And I know it's very tactical, but it's that level of detail that I'd be thinking about at the onset, and just set it up, and then you can people can follow suit. But I think that's an important piece, because it can take a lot of time.
Yeah, that's great. Andy, anything to add to that?
Sure. I mean, you think you've got data and information, and you've got reporting that you're going to deliver to them. And we did a great job of understanding our business. But be clear that the folks that are doing diligence on you, those reports are going to be great, but they want it like this. You've got it like this, and they need it like this. And these analysts, and on the other side of the table, these are guys that just 2 years out of getting in their MBA, and that's all they do for 12, 14 hours a day is crunching numbers. So the requests that come in can overwhelm you, and making sure that you think you've got a good handle on your ARR or your cost of customer acquisition, but they're going to want to see it in like 12 different ways. and you just got to be flexible enough. And at some point, enough's enough, right? Enough. You know, they end up knowing your business. We learned a lot through our diligence processes, just because they were able to take our data and slice it in a way we weren't even looking at it. So,
Right.
but it is a long, and depending on the, company that you're partnering with, they can use it as a weapon to kind of, grind you down and get you to as a strategic kind of weapon to get you to the point of fatigue that you'll give in to certain terms. But more than likely, and more than not, they're looking to understand your business. And it's a good indication of how they're going to operate post close in the way they look at your business. Is the requests and things that they're asking you through the diligence process. And it's also important through it to make sure who you bring into it within your company. Because you don't want to tip off the entire company of 250 people that the company is for sale. So there's a whole, way of protecting your customers and your employees, and making sure that, that the diligence process doesn't really cost you a whole lot in time and reputation with your employees and trust. Sure.
No, that's great. And I'll throw this out there and want to get your take on this in regards to valuation expectations, right? When I'm engaged with a client or, helping them, advise them through the situation, and statistics show 80% of all deals don't go through because either the seller's not prepared or there's a valuation gap expectation. What advice would you give people? Because I'm sure people come and say, okay, my company's worth X, and then a seller or even the banker saying, well, it's probably not worth that. Ashish, any thoughts on that?
Yeah, I mean, reality. I mean, I think just make sure you have a sense of what is market. And if you're really this far out from a gap standpoint in terms of where the market is and what your advisors are telling you, I mean, you've got to check yourself, because that's going to get in the way of you getting your deal done. And again, it's not necessarily that you're asking too much. It's just that you have no sense of basis of reality. And so all of a sudden they start to question a lot of other things. They start to not trust the data, and it's your reputation that's on the line as much as anything else. And so it's pretty easy to go get market comps. Your advisors, if you've got a banker or somebody in there, they're going to basically present you what the case scenarios might be. If you're smarter than them, go sell it yourself. Don't get anybody else involved, because you're just going to piss people off. But then at the end of the day, I think you need to have just be grounded in reality and trust the people that you're bringing on to help, just like you will with anything else, whether it's, with your personal finances or with healthcare. It's like, do you know better than your doctor? So.
Right. How about yourself, Andy? Any words of wisdom on that piece?
Everyone, looks at their business and they believe that they're an outlier valuation inside their special. And, you go interview some investment bankers, and in their pitch decks, they're going to show you those comps and where they believe you fit into it. And of course, when you're interviewing a bunch of different bankers, there's all kinds of scenarios that they'll show you of the outlier bid that might come from potential strategics or sponsors. And so, but there's, it's the law of numbers, and you're probably going to be inside the mean of where, companies like you get sold. And so, you can try to position yourself as a data company. Oh, we collect a whole bunch of, no, you're not. You are who you sell, who your customers buy product from you. And that's great that you're collecting a whole bunch of, but if you've not monetized, the data, don't think that someone's going to buy you to eventually monetize the data that you never monetized. You are who your customers pay you for and what you do every single day. So I think that helps settle some of the kind of outlier valuation comps that people think that if you're in a white hot, ridiculous space and you've got, a whole bunch of moats around your business and you're front runner, there's exceptions, but 99 times out of 100 that I look at businesses, I mean, you are going to fit squarely into those comps.
Yeah. And Ashish, you're an investor as well. So, you hear a lot of times when you're interacting with people, they're like, I want X multiple of my revenue, right? What do you say to those folks? And is that realistic in this landscape, or does it depend on the business?
I mean, it depends on the business, but I mean, listen, I think I mean, Andy and I just did an investment together for a company that's got, nominal revenue, but they're able to get an outlier valuation because they're tracking very well on a lot of fronts, and it's a white hot market, and the team and the product are great. Okay. But the next time they go to get money, things are gonna have to add up. And so what I mean by that is that, in the inception stages, or at the call it the pre kind of scale stages, you're able to sell your business and the opportunity on a PowerPoint deck. Once you get to the threshold by which you've got to start deploying dollars, and those dollars have to start generating dollars and EBITDA, you're selling on an Excel spreadsheet. And so, and again, this goes back to Andy's advice on stuff. Growing into a valuation is a very tough thing to do. So you better be able to execute that plan, because if you sold the dream and people have paid for it and you don't end up delivering, you're out. You're
Right.
out. The company's not going to get funded. Your investors are going to lose money, and so that's a risk. And so I think there's a certain dose of reality that's important, and and listen, there's guys that do it like them. There's guys that are doing it all day long, but that's their special. I'm not saying that we're not special. Andy's not special. You're special, but it's very tough to do, and so it's tough enough to be in these businesses. But being grounded and having a sense of reality is very important to everybody's outcomes. So,
Gotcha. Well, as we wrap up here, I got last couple questions for both of you. So you go through a couple of iterations of your careers. Now you're on the next, you're on your next venture. Why did your family think you're crazy for doing that? But also, for all the people that are watching us right now, we're lucky to be in Atlanta. I think Atlanta, the tech scene in Atlanta is really underrated. It's very robust. So really wanted to get your thoughts of the tech community in Atlanta a little bit, sort of weave it in there. But tell us what's next and why, and what you're doing right now with Cyrena Systems, and what's your end mind with the company with that.
So your question of why, I asked myself the same thing a lot of days, but I have 4 children, and I just don't think it's good for my at the time 8 and 10, they're 12 and 14, but they don't need to see dad doing nothing. So I've got all these ideas in my mind and spreadsheets of kind of concepts and ideas, and I run them out and I build them. And Cyrena was the one that, with my old CTO from VendorMate, Gopal Cortana, who's involved with Ty and great friend of mine. This was a product we wanted to use at VendorMate to help us with employee communications and outreach. And so we decided to build what we could not find and what we couldn't buy. So we're just having a great time, building the solution and doing the same thing, kind of rinse and repeat. We get better the more times we do it. And so I feel like we're better entrepreneurs and business people, going through it again. And to speak to the Atlanta tech community, this is the 3rd time I've taken a company through the Advanced Technology Development Center. It's the ATDC down at Georgia Tech. It's one of the oldest business incubators in the world. And I do it because it's just an unbelievable place to network, community. It's part of the community. I met Ashish and a lot of great friends I continue to do business with, but it's great for the early employees too, because if they have a place to go to work, that's great. But if they're stuck in a cubicle in a suburban, office park, they don't get that ability to collaborate and have this community and this culture that the incubators provide. And before you're a 50-person company, you don't have a culture, so being able to work in these multi company incubators, it has its culture that you can leverage and that they get a lot of value. So there's learning, there's the happenstance of running into somebody on the way to the water cooler that you can talk to. It's the CEO roundtables that I continue to learn from, whether it's, I haven't started a company, last company was 2004 that we started. So the stage of business that we have been in, you only go through it a few times and it changes and it's evolved. So learning from CEOs who are starting companies today is a lot different than it was 10 years ago. So I'm a huge proponent of starting companies with the support of an incubator, organizations like TIE, ATDC. I mean, just lessons learned from people who've done it before. It's just invaluable.
That's fantastic. Ashish, what about you with Control Freak? I mean, why do it again? And did your family think you're crazy? And you've been involved with the tech scene here as well. So
Yeah, I mean, I grew up in sort of the, business family, not realizing that we were, my dad was an entrepreneur as well. He never came home and was like, oh, I'm an entrepreneur. He's like, hey, we've got stuff to do. We got to sell some stuff. Let's go to the store. And so, so I don't think they think I'm crazy. I think there's no real reaction to it outside of, okay, it's just normal, I guess. That's maybe if your dad was a physician, if your dad was a physician, you'd think that was normal too. But so from that standpoint, there's no presuppositions around how we should behave or not. But I think we do it because we get to write our own script, right? We as Andy said, you get to learn from a lot of smart people. There's lots of energy, and we're a product of the ATDC. I started the company, in a single office there as an EIR. And right about the time Andy was, they were in the middle of vendor mate. And so we've sort of seen each other and grown up around each other in that way. And ultimately, we continue to do it again because the journey is really fun. The outcome can be great, and you can really help change people's lives financially as well as professionally. And then and it's satisfying. I think you're always working a problem. It's not like you're going to go home. You're not going to go back to the office and do the same thing the day after. And so that creativity piece is extremely important, and I think it's energizing, and that's what I take away from getting to do it every day.
Fantastic. Well, guys, this has been a lot of fun. Really enjoyed hearing your stories and getting to know you a little bit better. And Ashish, I remember your dad's store is still Time and Sound.
It's still there.
Electronics still there? Really? That's fantastic.
Now it's like the country club for all the uncles and watching CNN and Scotch at 4.
That's great. That's great. So with that, we'll go ahead and open it up to questions to see if we have any of those coming in. And I may have lost track of my timing. Not the best moderator work of my career, but so we'll wait a minute, see if any questions come in from our viewers. Viewer. So with that, I don't have anything so far. So with that, again, guys, thanks so much. Really appreciate talking to you guys today on this fireside chat. And I guess I'll pass it back to Amin, correct?
Thanks, Tom.
Yep. Thanks, guys. Very insightful panel. I think, Tom, kudos to you to really break down kind of the different elements of the exit, right? It's never the same any time around, but also I think the inflection points and also the family life balance. I did have a question. I think you kind of ended off with this in terms of, why. I wanted to know, how is that, through each of the ventures, I know that, keeping in mind that, you are going to be doing this again. Did I lose you guys?
No, I'm here.
Yeah, I'm here.
Okay, everyone just froze for me. My fault. Everyone's still frozen for me. But my question is that, so how is the family life balance aspect of it incorporated when you rethink or when you say that, hey, we are going to go back into, going to build another startup again or giving that focus? So how does that conversation go with your family or to let them to understand that, hey, you have a sense of mission, you have a sense of purpose, and how does that dialogue work out? And maybe some advice for the entrepreneurs that are doing this multiple times. Maybe it's just some advice about that family life balance.
I'll tell. So I think one of the coolest things that happened early on with BroadSource was Bird Blitch's mom took my wife, we've been married 2 years, out and talked to her about what it was going to be like to be married to an entrepreneur, because her husband had started a bunch of businesses and just wanted to make sure she was, aware of what life would be like, and that, Andy's not going to be around. He's going to be traveling. He's going to work long hours, and just making sure from her perspective, that what life was going to be like as a mom, and knew just kind of her experiences as being a wife of an entrepreneur. So one, I think it's important to get moms and the wife's buy-in, but the other one is just, I tell folks, you're going to lose something if you do this. If you're in a startup and entrepreneurship, you will lose something. And just what you hope is you don't lose something of value. because it's relationships, it's sleep, it's money, there's opportunities to learn a whole bunch, your ethics, your morals. I mean, so you got to make sure that you're not willing to lose the things that are most important to you. If your family's most important to you, you just got to make sure that you're not going to lose that. You'll lose something else, but you got to identify the things you're not willing to lose.
Yeah, I think I would, if you ask me the same question, that's probably the spot on point. Sort of the three legs to the stool, pick, you can't have two. So.
Great. So it looks like Andy, you did an excellent job with summing that up, and really appreciate it. I think it was just, some of those tactical things that sometimes, I think people need to know that entrepreneurs are humans, and though that serial entrepreneurs want to always grow and be able to nurture businesses and really, bring together a solution that makes sense. And obviously any solution that you bring forward takes time, takes tending, and that you have to balance a lot of things because, things with family are always one of the things that, entrepreneurs always like to prioritize, but being pulled in different directions, especially with a lean team, can totally understand. So I think so far have not seen any questions come through. So I think everyone did an excellent job of really breaking things down. So with that, we're going to go ahead and conclude our Atlanta track. All the Thai viewers that are watching this, thank you guys so much for your time. If you're looking to connect with Andy, Ashish, or Tom, I know that their LinkedIns are provided for the speaker info. So give them a shout there. Or if you're visiting Atlanta, happy to, give you guys a way to be able to get access to ATDC so you can visit Andy and visit Ashish, and then also see them at a Thai event, that we're going to be curating again in 2021. So appreciate the time, guys. Tom, thank you again. Andy, thank you. Ashish, thank you. And Gopal, Sanket, any last words before we go ahead and close out our Atlanta track?